Well, good morning, and thank you for being with us. Welcome to the OneAscent Market Update for Q3 2021. My name is Cole Pearson. I'm the Vice President of Investment Solutions here at OneAscent. I'm glad to have you with us. We've got a lot of exciting information to share and some exciting presenters that I'll be introducing in just a moment. As we jump into our agenda, excited to introduce Andrew Manton and Nathan Willis, who will be our key speakers today. Just by way of agenda, kind of some housekeeping items really quickly. These calls are recurring. They're on the third Tuesday of every quarter at 10 a.m. Central. So go ahead and mark your calendars for our Q4 call on October 19th. And even thinking out into 2022, in January, we'll have our Q1 call. If you have questions at any time throughout the call today, please submit those by email to info@oneascent.com. Hopefully we'll be able to address them live on this call, but if not, we'll be able to follow up and get those answers back to you either later today or throughout the week. As we jump into our presenters, it's always helpful for those on the call just to know who is speaking and maybe why. So I want to articulate and kind of show a visual of how our investment team works for you on your behalf. If you're a client of an advisor, obviously that's your key relationship. That's your point of contact. That advisor is the one who gets to sit knee to knee across the table from you, and they're the one who ultimately is in control. But behind them is our investment committee. So at OneAscent, we have an investment committee and an investment team who put together our solutions and serve advisors all over the country. We also oversee our portfolio managers. We work with lots of firms, household name firms, who help us integrate our portfolios in a values-aligned, kingdom-driven way. And so today, as we do in every call, we like to highlight one of those managers. And so today, we're pleased to have Andrew Manton of Shelton Capital Management with us. He focuses in the international equity spaces. Andy actually has an interesting story going back 3 years. He's been in our portfolios for the past 3 years or so, but came up on some of our screens the investment committee was running and identified him as a potential good fit for what we were looking to do in the international space. And that's been a fantastic partnership, a fantastic working relationship, and glad to have Andy join us today on the call. So with that, Andy, I'll turn it over to you to talk about the Shelton International Select Fund.
Yeah, thank you, Cole, and everyone at OneAscent for having me on today. I thought I'd just touch on who Shelton Capital is real fast. And basically, we're a $4 billion asset management firm based in Denver, and we have investment teams located on the East and West Coast. I live and work in Connecticut, and I manage the international strategies at Shelton, which consists of the International Fund, international SMAs, and a new emerging markets fund that I took over last year. And for all these strategies, we use a unique process that is guided by the philosophy that a company generates value for its shareholders by successfully redeploying capital over time. And by analyzing a company according to its life cycle stage, we believe that we can most effectively evaluate its risk and return potential and more accurately forecast the company's likelihood of generating value for shareholders. And I'll go into that a little deeper in a moment, but we also use what I call a principles-based approach, because I believe that we have a dual mandate to invest our clients' capital, which I'll go into a little bit more on the next slide. With this approach, the first question we really begin with is the product or service this company provides helpful to society in some way? And we want to be confident that the main business of a portfolio company is fundamentally positive to the community it serves. And this sounds pretty basic, but that simple question steers us to proactively seek out the companies that are positive contributors rather than just seeking to avoid the companies that the screens tell us to avoid. And as part of our fundamental process, we do a thorough examination of each company to check for alignment with those principles, as well as the ability to generate superior and consistent returns on capital. And we focus on going beyond the numbers and seek to understand the overarching impact our companies have on the stakeholders in which they serve. And these core principles are at the bottom of this slide here, and I'll explain more in the next slide of what these 6 mean. Okay, cool. Thanks. So, these 6 main principles that we focus on are summed up here. And number 1, again, the products or services have to be positive, have to have a positive impact on society in some way. And we're not thematic in any way. These can be very different things and mean different things, but we look at the merits of each individual company to look at their products and services and try to decide if those are fundamentally on balance positive in some way. And number 2, we look to see if the company is engaging in community building rather than production of products or services that contribute to harmful or destructive behavior, like gambling, alcohol, cannabis, things like that. But we also consider things like, video game development, things like, and social media, for example. Those things wouldn't pass our basic first screen, our basic first test. We don't think that those are fundamentally positive to society, and so we just won't invest in those types of companies. Number 3, establish responsible procurement policies and procedures. And we really ask each company for the policies. We want to see those policies that they have in place for their supply chain management, to see really what they have in writing. We just want to make sure that those are dealing with issues that are relevant in certain countries. And each company has a different set of policies that they use for this. Number 4, have demonstrated a respect for human rights. This can mean a lot of different things, but in countries that have a less than stellar human rights record, we look for signs that a company might be helping governments with their human rights violations. And so obviously we're going to avoid those companies that do that. Again, this is true in countries, are very prevalent in countries like China. Number 5, establish policies that show a commitment to the value of their employees. We ask to see the policies around hiring and employee retention. And then finally, number 6, did the companies have an ethical leadership team in place, and what about their board of directors? So we'll look at the executives' past records, if they've been at different companies or within the company that they're at now, just to try to get a sense for their character, what they've said in the past. Is it truthful? Did they have a record of being truthful with shareholders? We just want to make sure that the board also has an adequate number of outsiders, and that they are truly independent and have experience that is relevant and value add to this particular company. Go ahead, Cole, next slide. As I mentioned, our philosophy also includes the idea that companies go through a corporate life cycle. And we believe that knowing where a company is in that cycle is a much better starting point in the investment process, rather than concentrating on what sector or industry a company is in. Now, this slide shows what we believe to be the 5 different life cycle stages: innovation, expansion, deceleration, maturity, and distress. I won't go through all of these now, we just don't have time, but basically it starts off in the growth phase and then peaking at a level where competition starts to come in, and then the company matures. And sometimes eventually goes into a place where they're really having a hard time competing and actually destroying value over time. We look at companies in all stages, and the things that we ask each company is then different depending on what life cycle stage they are in. And we have quantitative tools that help us, number 1, figure out which stage every company is in, and then we use a proprietary multi-factor model to screen and rank each company in each life cycle stage, and then which helps us narrow down the universe a great deal. Next slide. And so this is our investment process in its entirety. We start with the investable universe, which is basically any company outside the US that is greater than 2.5 billion in market cap. We apply our life cycle screen to it. Again, this is all quantitative. It happens behind the scenes. We don't spend much time with this, but it gives us a ranking each week of the companies in our universe, and we look for new companies that are popping up into the top 20% of the ranked universe. And that's where we believe we should be fishing for ideas. And once we have an idea that, or a company that we're unfamiliar with, or that is new to that top quintile, we then apply our stock selection process, which is our fundamental process. And this is where we spend 90 to 95% of our time in step number 2 there. We build out detailed valuation models on every company we look at. We talk to management, we talk to competitors, and we try to figure out the potential to create value over time and make sure that not all that potential is priced in already. And this gets us to an investment thesis that we debate internally around the merits of each new company that we consider for inclusion into the portfolio. But once we have those ideas, we may or may not put it in the portfolio right away. But in step 3, we have a portfolio construction phase where we do optimizations, and we looked at the overall risks of the portfolio and try to decide the weights that companies should have in the portfolio at any one time. And that gets us to not only the international fund, but all the different funds that we run. Next slide, Cole. So I went through that pretty quick, but I wanted to talk about why I think there's a pretty good investment case to look at international companies right now. I did a webinar on this topic last year, and by the way, you can find it on our website. You can email me, and I can send you the link if you'd like. But it goes through in much more detail of what I'm about to touch on. So why international? Number 1, the U.S. market has outperformed international stocks over the last decade, but when you look further out, international markets have actually outperformed 3 of the last 5 decades. I did this webinar last year because I kept getting the question of why should I even be looking at international? Doesn't the U.S. always outperform? And certainly coming out of the last 10 years, it certainly appears that way or feels that way. But when you look further out, in this case, we looked at the last 50 years, we noticed that international stocks have actually outperformed 3 of the last 5 decades. And these are trends. They usually happen in cycles that are usually about 10 years long each. And if you look year by year, even 26 of the last 50 years, international markets outperformed, and that's up through and including 2019. The point is that the US does not always outperform, and that these things do happen in cycles, usually 10-year cycles. So number 2, some of the best management teams and CEOs are at companies outside the US, while the ones in the US are seemingly concentrated at tech companies. I point to a study that the Harvard Business Review did on this. They have, every year they do a study. It's a quantitative study, and it looks at shareholders of the best performing companies around, or sorry, it looks at the executive teams, CEOs at companies, at the top 100 companies, performing companies outside the US, or sorry, including the US. And it's an interesting study. It's a little different each year, but as of last year, which looked at 2019, it found that 37% of the top 100 CEOs, top performing CEOs, are in the US, only 37% of them. So the rest are CEOs that are at companies outside the US. So again, this is a study that looks at the CEO's tenure. It looks at the stock price for when they first got into their position and what it is today. And then that's just that determines how much shareholder value that they've been able to produce. So the majority, again, are outside the US, which is interesting. But if you look at the top 20%, the top 20 names, 9 of them, almost half, are in the US, but most of those are at technology companies. And given how tech has done over the last few years, it's no wonder. But the question is, will that last? Is that really going to keep going the way it's been going? But something I'll touch on in a second here is that if you look at the CEOs that are companies outside the US, very few of those are technology companies. They're very diversified industries, and that makes it all the more interesting, I think. So number 3, the question I get is a lot is, or the argument that I'll get is, the economic health of a country or region isn't good. Europe, I always am asked, is a region that's not growing nearly as much as the US. So why should I invest in anything in Europe? And so my argument is that the economic health of a country or region doesn't necessarily determine the health of a company that's domiciled there. We looked at the top 100 companies in Europe, for example, by size, and saw that 61% of revenue comes from outside of Europe. So the majority of the revenue of those companies comes from outside of Europe. So that sort of proves our point that these companies are not just dependent on the European economy to drive their businesses. So something that is true for most of the companies in our portfolio. We invest in multinational companies, large cap companies around the world, and so they're selling things to customers and all over the world. And then number 4, when you look under the hood, the U.S. market is being held together by several factors that may be temporary. I think there's a lot to dive into here. I'll just touch on a few of these things, but the first point is that low interest rates have driven foreign demand for USD assets. Will this continue now that the US rates are close to zero? Over the last 5 years, we've seen a lot of demand, especially coming from Europe. Europe is now the biggest holder of treasury bills. US treasury bill is much bigger than, as a whole, much bigger than what China or Japan hold now. But the money from Europe is definitely going into bonds, but also equities as well. And the reason that is because interest rates in Europe are usually below zero in most cases, and there's a search for yield. So coming to the U.S. was a natural trade, I think. And the question is that going to last? So will that demand keep going as much as it has been in the past? My guess is no. It's at least going to slow down. One of the points, tax cuts help to shield falling pre-tax profits. What's not really talked about is that since 2014, pre-tax profits in the U.S. of corporations have actually been falling every year. When Trump was in office, he, of course, put in some nice tax cuts for corporations, and that really helped to shield or to hide the fact that those pre-tax profits have been falling. And so bottom line profits kept going up because of those tax cuts. But we all know now, I think that might be in jeopardy. Certainly that's going to be challenged in the new administration. Another point, share buybacks have been an incredible market force, but are now being closely studied. Share buybacks have been, I think a lot of people don't know this, but the biggest demand trend for US equities. 4.3 trillion have been made on buybacks from 2009 to 2018, for example, or 52% of net income for corporate America. That is an incredible amount of demand, and it's coming from a couple different sources here. But really what I think, though, is that this is interesting because buybacks don't happen at nearly the level that they happen here in the rest of the world. It's purely a US phenomenon. And I think there's some reasons for it, but CEOs, the way CEOs are compensated in the U.S. is very different than the rest of the world too. It's mostly based on earnings per share, which drives these decisions around corporate buybacks. Anyway, this is an interesting topic. I can get more into this, but it's really being studied now. It's become a political issue, and so that might slow down at some point as well too. Another point is that corporate debt, which is at already unprecedented levels, is being used for these buybacks. Corporate debt is now at 11 trillion in the US. That's up 10% in 2020 alone. And prior to 2020, 30% of buybacks were made with debt. So these are companies that are using debt to buy back their own stock. So it's a levered play. It's levering up the company to buy back their own stock. So it's a short-term juice of stock prices. And the question is, again, what happens when rates go up, and will this continue? Another point, the Fed backed into a stimulus corner now. Is there justification for more, and how do they reverse? This is a big topic. There's a lot to talk about here too, but we think this is going to be messy. You know, when the Fed is finally forced to reverse course because of some of the bubbles that they're creating, what kind of impact will this have in the market, and all of these other points that I just made. And finally, all of this is combined to lead multiples to levels that haven't been reached since the tech bubble, and growth stocks are accounting for most of the disconnect. You know, by most metrics, the valuation gap that we're seeing now in the US versus the rest of the world is at record levels. In the US, the trailing price to earnings is at the highest levels since the tech bubble, and the forward PE is close to the levels back then as well. So it's interesting, and this is all, as I said, this is all, not all, but mostly coming from the growth stocks and mostly technology names. And it's interesting because it's really transformed the S&P 500 and its makeup and how it looks now versus 10 years ago. The S&P 500 is now made up 30% of the weight in the S&P 500 is now in technology names. Tech in my index, which is the MSCI ACWI ex-US index, is just 8%. So 8% versus 30% in technology. So a very big difference there. But you know, if you dive deeper into the S&P 500, and some of this has been talked about a lot lately, but the top 5 companies are now close to a quarter of the total index capitalization. That's amazing. If you just look at 5 out of 500, the top 1% equals 25% or close to 25% of the total market capitalization. One point there is, there's, as we know, there's antitrust coming down on some of these companies. Will this slow down growth? What impact will that have? But these 5 names have really been driving the entire index. And so it's something to just be aware of and have caution with as we move forward. 50% of the names in the S&P 500 actually underperformed the index by over 10 percentage points last year. That's kind of alarming when you stop to think about that. So all this combined, I think, is just something to think about when you're looking at diversifying portfolios or client portfolios, going forward. There's definitely some risks in the U.S. market. We don't see a lot of these risks in international markets. So that's really the point that I wanted to make here. So I'll stop with that, and I think that we might have some time for Q&A.
Yeah, thank you, Andy. Those are definitely some good points that you've shared. The first question is for me. I think everyone on the call is going to be U.S. based. You mentioned you're in Connecticut, and in making your case for international, you spent a fair amount of time talking about the U.S. Maybe explain to us, why is it important that you kind of keep your foot on both sides, if you will, understanding what's going on here at home as you're making investment decisions abroad? Can you explain sort of that dynamic of that relationship?
Yeah, and I think we talked about this a little bit too, Cole. I mean, when I write my commentaries, I always write about the U.S. It's obviously the biggest economy in the world. It drives a lot of activity that happens in the rest of the world. But more technically, central banks are sort of all linked together now. The European Central Bank does. They don't do everything independently of the U.S. Fed. So they have to be aware. They have to be aware of currency levels, and if they were to raise or lower interest rates without considering what the Fed is doing, then they may lose control of different things, including the currency. So a lot matters to the economic environment outside the U.S. because of what happens in the U.S. Certainly, the U.S. is a big market for products and services of companies based outside the U.S. as well. So it's kind of like what we think of China. It's a big market. We have to be aware of what's going on in China. Our companies have to be aware of what's going on in China because China represents a big potential market for companies. And so it's the same thing with other companies based outside the U.S. when they look at the U.S. So it's all integrated. It all works together. I definitely need to be aware of what's going on in the U.S. from all facets. When we look at the currency, we look at the political situation, we look at the central banks. this is what we do when we go into any country, especially emerging markets, but they're all sort of tied together and interdependent on each other. So we have to be aware.
That makes sense. This next question has to do with kind of on the international side. I'll preface it by saying I think we're all comfortable with what's called home bias. We tend to like to invest in things that we know, the companies that we see around us are advertised, and there's many international companies that we're just not even aware exist. And related to point 3 of what's here on the slide, how do you think about countries who, you mentioned China, countries who may be somewhat at conflict with the U.S. or doing things that we as values-based investors don't necessarily care for or agree with, maybe even in the Middle East? How do you think about that from an investment standpoint? Is it the country, the government, the company? So what are all the dynamics at play, and how do you navigate that as you're investing in a principles-based way?
Yeah, great question. This is something that, obviously we have to deal with every day. And we do have policies in place around each individual country. So that's part of the answer there is we do look at every country on a country by country basis with their, each individual country has their own merits, and we consider each country alone. So there is countries that we just won't invest in. An example of that is Russia. We have found that over time, it's just been very difficult to find companies in that country that are not caught up in the culture of corruption in Russia. That corruption is everywhere in Russia. It is certainly filtered down into the corporate boardrooms, and it's just very difficult to operate within the Russian corporate environment without, contributing to that or being, involved with that. And so we just take that risk out. We just don't invest in any company within Russia. China is a much different and interesting topic. This is something that we've been writing about for a long time. It's certainly, if you read my commentary, it's my biggest concern. It's something that I think hasn't been talked about for long enough, or paid attention to for long enough. Certainly, we have a lot of feelings about what happened with Hong Kong last year, but we've been watching, what the Chinese Communist Party has been doing for the last decade at least, and have been very concerned. My biggest problem, besides the human rights violations in China, has been the systematic theft of intellectual property. China has a policy in place, which is interesting because just yesterday, President Biden touched on this. That he said that basically he's aware that the Chinese government has been seeking help from outside of the PLA, the army, the usual sources of hacking, by trying to get help from other groups. And this has been happening for a long time. I'm not sure why he's just saying this is a bit of a surprise. It's not really new news to us. This has been happening. There's millions of people in China that the PLA has loosely been affiliated with that try to hack into corporations and governments all over the world every day, millions. And I can cite papers that discuss this. But what they're trying to do, and this is a policy that they have in place, is they're trying to steal intellectual property to further the advancement of companies within China. And so they take any kind of intellectual property that they're able to steal, they give it to those companies, whether they're private or public, so that they can benefit from that. And so this has been happening in lots of different industries. I can cite a lot of cases on this, but this is slowly eroding industries throughout the world, not just the US, but for companies all over the world. And so this is a big deal from an investment standpoint, and something we talk a lot about. And so we have policies in place that prohibit us from investing in companies that may have benefited from anything that might have been stolen. So that usually means companies in industries that are on this list of priorities that the Communist Party wants to advance. So there's basically 10 industries that were cited in a paper called Made in China 2025. And those companies in those industries are definitely benefiting from any kind of intellectual property theft that the government's able to steal. So we just don't invest in those industries in China. Another thing that we won't invest in is any kind of company that has any kind of state sponsorship or ownership at all. And so we do a thorough examination of not just direct owners, but also affiliated owners or any kind of other influence that a company might have from the government. We're just trying to stay away from any kind of government influence whatsoever. And so this really limits the amount of companies that we do invest in China. But I've stayed clear of just having a blanket, do not invest policy in China, because China is so big and they have so many. It's a very entrepreneurial society, and they have so many companies there that are trying to do the right thing. They're trying to create products and services that are helpful to society, usually the Chinese society in some way, outside of the government's purview. So it's rare, but we can find those companies. But it makes us and helps us look a lot different from most funds, because nobody else really is talking about this, and it's been such a big deal for us, and we've always been underweight China. But running an emerging markets specific fund, we're that index has China at about 40% of the index, and so we're never going to get there. We're always going to be way underweight China in that fund, and that makes us look much different. But it also helps us just talk about these issues a little bit more from an advocacy standpoint, if not with companies, but also with our clientele, with our clients, because clients might not be aware of these issues as a man of faith. I get to talk about my values to clients about this topic. So we do, it's a long answer to your short question, but we do have lots of policies in place, and there's other companies or countries that we won't invest in like the Middle East, as you mentioned, some of the GCC countries. But we go country by country to determine, what we view as the acceptable risks.
No, that's great, Andy. Thank you for that kind of color. I think we, as value-based investors, at OneAscent, we're looking to put forth values-aligned, kingdom-driven portfolios, and just the sort of even somewhat the depths that you go through and the redemptive nature of that. We certainly appreciate the fact that it's not throw the baby out with the bathwater. There are people who are image bearers. There are companies in places like China that are not involved in some of the things that we see on the news, and so we appreciate the depth and the level of diligence that your team goes through to find those companies, and where appropriate, if it makes sense from an investment standpoint, deploy capital. That's certainly what we are seeking to do. Well, we're out of time and need to move on to the next phase of our call. But Andy, I want to just again thank you for your partnership, and thank you for making time with us today and sharing some of your thoughts on your strategy. We appreciate you.
Absolutely. Thank you, Cole.
All right, well, as we move into our investment committee outlook and update, again, if you have questions throughout the call, you can submit those to info@oneascent.com. As we transition to the final phase of our call today, it's always helpful just to come back to our philosophy. It's important to remember why we do what we do and how we think about the world. And so I wanted to articulate that again for you. Our investment philosophy has 3 key pillars. Number 1, it's values-based. And we believe that aligning your investments with your personal values is actually a wise approach to investing. Number 2 is long-term. We maintain a long-term focus, both in our analysis of investments, but also how we manage our business. We need to be around, we need to be here to continue serving our advisors and clients well. And thirdly and finally, globally diversified. We invest across multiple markets and asset classes to mitigate risk and enhance potential long-term return. And so that includes investing outside of the U.S. That includes investing internationally. It includes investing in stocks and bonds and different asset classes that make sure our clients are set up well, ultimately for their long-term goals. It's not just about a decimal point or percentage return. Each client who works with an advisor or who is invested in the investment solution has specific things they want to do in their lives. Whether that's retirement, or sending their kids to college, or or travel. And so we stay diversified to make sure you can hit those ultimate goals. The way we do that is we build risk-based, globally diversified portfolios, ranging from preservation to equity, essentially from a conservative type approach to an aggressive or growth-oriented approach. And so I'd encourage you, if you're a client or an investor with OneAscent, to speak with an advisor about which portfolio may be appropriate for you. The way that we put these portfolios together is there's really two key components. There's the strategic component. You can think of that as the roadmap. It's the plan. If we're going to go from where I'm sitting today in Birmingham, Alabama, to Washington State, I know that I need to go northwest. And so I'll get started on that plan. But of course, as things change, we need to stop for gas, we need to spend the night somewhere, we get off course. And so we need a tactical component or a way to navigate and get back on course. As it relates to markets, that's what our tactical component is. It's a way to navigate the ups and downs of the markets. Even this morning, this week, we're seeing kind of some volatility as we news about the Delta variant and different things in the market. This part of our portfolio is meant to give you what's called behavioral alpha. It allows investors to stick to their plan. And we're still trying to get to Washington. We still know which direction we need to head. This allows us to stay on course. The way that we do that is when we put these two together, they fit nicely together. The way that we do that is what we call our navigator outlook. And we look at systematic things in the market. We look through different lenses so that no one data point could throw us off course. We look at valuation. We look at what's happening in the economy. And we look at sentiment. How are investors feeling about the market? How are businesses feeling about their outlook? And then we look at technicals. What's happening intra-market in terms of trends and intra-market relationships. And so with that, I want to introduce Nathan Willis, our Director of Portfolio Strategy, to talk about our Navigator Outlook. Nathan joined us in early June from a long history or long experience in the investment space, in the multifamily office space, working with high net worth clients and family offices. We are excited to have Nathan join us. He was a great fit from a value standpoint, from an investment standpoint. And so with that, I'll introduce Nathan Willis to give our investment committee outlook. Nathan?
Thanks, Cole. It's great to be here. I'm just thrilled to be at OneAscent where I can live out my faith. Not a lot of people get a chance to do that, so it's just great to be here. Just a little bit about me personally. The first 5 years or so of my career was spent on the institutional side, managing bond portfolios, and then I worked on a large cap growth mutual fund. And then the last 20 years of my career, I have spent building portfolios for families. Much of that was at GenSpring, which was the family office group of SunTrust Bank, where I served on the investment committee, did a lot of manager diligence, both in the public side and the private side with hedge funds and private equity. And then prior to coming to OneAscent, I was the chief investment officer of a single family office where I kind of revamped the strategy for asset allocation, manager due diligence, and private equity sourcing. I had a really enjoyable time there, and I'm thrilled to be here. I have to clarify, though, the very last bullet point there. I will reside in Birmingham soon. In fact, the movers are at my house this very moment. I'm moving from Raleigh to Birmingham and thrilled to do that with my wife, Kate, and our 3 sons who are 7, 5, and 2.5. So with that, let's dig into the Navigator. The first thing we're going to look at is something that we look at a lot, and I'm not going to spend a lot of time on it because it's telling us the same thing. Everything is expensive in the stock market, no matter how you look at it. Price to book, price to cash flow, price to earnings, and dividends. Things are pretty expensive. But importantly, that does not mean the stock market's going to drop. It does mean maybe we're a little bit more at risk for a drop like we had yesterday. We had some bad news about the Delta variant, and the market reacted. But this means more that what we expect going forward is a little bit of a moderation in returns. Stock market was up 15% for the first half of the year. You should not expect another 15% for the second half of the year. But you might want to expect a little bit more volatility. That's kind of what we think of there. Now, we scoured far and wide to try to find something that would be optimistic about stocks, and the next slide shows that. This slide shows a comparison between the earnings yield of stocks and the yield of corporate bonds. So the earnings yield of stocks is the inverse of the PE ratio. So right now, PE is about 22, so the earnings yield is about 4.5. Don't pay attention to the scaling on the left. We index it to 100. But what this tells us is that earnings yield of the S&P 500 is better than the yield of corporate bonds. It's worth talking about the history of this for a little bit. You can look back to 2009, 2010, and for the 5 years prior to that, the two tracked each other fairly well. But then in 2009, 2010, interest rates kept going down, similar to what Andy talked about, and the earnings yield of stocks maintained its premium. So stocks have appeared cheap relative to bonds really for the last 10 or 11 years. And so this hasn't given you any kind of a tactical signal either. But to me, what this says, and this I think keys in or goes along with some of the things that Andy said, one of the really important supports for the stock market is the Fed's quantitative easing. I think it may have to do, some of this may have to do with quantitative easing. So as long as the Fed is supporting the stock market through quantitative easing and keeping rates low, we feel pretty good about stocks. But that's really the best we could come up with for valuation. So if we go to the next slide, we can see that we call valuation red. It's not a dark red, but it's definitely red. So the next thing we want to talk about is the economy. And so today, what we're going to look at in the economy is earnings. We are in the thick of the second quarter earnings season. And what we're going to do is we're going to look at how earnings have changed and how the price of the stock market has changed. So this chart has two lines. The black line is at any point in time, the 12-month forward-looking expectations for earnings. So today, that number is about just over 200. So today, for the next 4 quarters, what analysts expect, okay? The blue line is the S&P 500. And you can say they don't track perfectly, but they track at some level. And then you can see they both had a big drop in the first quarter of last year. And one of the things I think is pretty interesting about this is that in August of last year, so after the second quarter earnings season had wrapped up, in August of last year, the market expected 2021 calendar year earnings to be below 2019 earnings. So that where that line kind of peaked out was they expected the earnings in the beginning of 2020, they expected earnings to be 180. The actual earnings for 2019 were 160. So a year ago, the expectation was for very low earnings, and that expectation has come up drastically. That's a pretty good support for the stock market. They don't track perfectly, but it's really important to understand that we've been up 60% in the stock market over the last few quarters. Earnings have really been a good support for that. So we feel very good about that. Another little tidbit to note is how companies interact with Wall Street. So one of the things we look at is pre-announcements. So you're coming into earnings season, a company says, Wall Street's expectations are this, we actually think it's more or less. And so a positive pre-announcement says we think our earnings are going to be better than the street thinks. And so this quarter, we had 66 companies so far that have pre-announced positive earnings or pre-announced earnings better than the street thinks they're going to have. That's actually the most pre-announcements on the positive side that have ever been since FactSet started tracking this in 2006. So it's a really good support for the market. Next, we're going to look at purchasing managers. So this chart shows you the ISM New Orders Index. The ISM is the Institute for Supply Management, and what they do is they go survey purchasing managers. So they call them up and they say, are you buying more than you bought last month, the same last month, or less than you bought last month, okay? And then they create what's called the diffusion index. And a diffusion index, what's important about that is a level of 50 for the index means it's about the same on the whole, okay? And below 50 is contracting or getting worse, and above 50 is getting better. What's important about this is that for the last 13 months, this has been not just above 50, but significantly above 50. So we've seen a really good, really strong recovery in new orders. Importantly, this component or this index is one of the components of the Conference Board leading economic indicators. So this is actually important for the outlook, and it's just a really good support. So to wrap up the economy, we think the economy is great right now. So we're positive. It's not strong, but it's pretty good. Sentiment is the next thing we're going to talk about. And I'm going to show something I don't think that we've looked at before. This green line is the AAII Investor Sentiment Survey, so the American Association of Individual Investors. And what this is the 8-week average of the bullish minus the 8-week average of the bearish, okay? And so I've done that because it's a little smoother. And what you see today is that we're kind of near a high of 20% more bulls than bears over the last 8 weeks on average. But take a second and look at this chart and look back at what some of the bottoms have been. I'm going to give you just a second to do that. Let's talk about 3 of the significant bottoms. The first time this went below 0, in other words, on an 8-week average, there were more bearish people than bullish. The first time that happened was almost exactly October of 2002. If you can remember back that far, you'll remember that October of 2002 was the absolute bottom of the tech bust. And if you bought stocks in October of 2002, you'd have done fantastic. The next one, and the worst reading here was in March of 2008. And this one was on the day, or corresponded with the day when Bear Stearns went belly up and was bought by JP Morgan, which was a really, really big deal on Wall Street. And then you saw sentiment stay negative really through beginning of 2009. And if you look at 2009, that was another fantastic time to buy stocks. Then if you go all the way through the bull market and come to last March, we had a very negative sentiment in the middle of last year. It was a great time to buy stocks. So one of the things I think I want to talk about with this is sentiment tends to be better at helping you remain invested or increase your investment in stocks when sentiment is really negative. So when sentiment is really positive, you can see there's a bunch of times that it's positive. It doesn't always mean the market's going to drop. It means maybe the market's at a little bit higher risk for a drop, but it's not a clear signal. So right now, even though sentiment is high on an 8-week average, bull minus bear, one of the things that has kind of happened in the last couple of weeks is that bullishness has dropped a bunch. In fact, just this last week, bullishness was 38 and bearishness was 26, or 36 and 26 rather. So it's just a 10-point spread, which is almost kind of average. So sentiment is fairly supportive here in this environment. The next chart I'm going to show is a chart of COVID cases. And we have not considered this as part of sentiment. It's been part of the economy before. But the reason I'm including it as part of sentiment is this. Number one, most economies have opened up in the US. We were thinking of pulling a chart, a map of all of the states that would color code them on how much they're opened. And we decided not to do that because they were all fully open except for Hawaii. And now you can add California and Ohio. Over the last couple of days, they had a little bit of restrictions. But we're less worried about this from an economic standpoint because vaccination programs are in place. And what we think this is going to do is really affect sentiment more. So if we see cases spiking, it's going to cause fear. It's not necessarily going to cause the economy to shut down again, at least at this point. So it's a little bit too early to say, but this is actually kind of a positive for us because of where we are in vaccinations and reopenings. So net sentiment is a positive. I would say it's a slight positive, and there's a little bit of risk there, but it's supportive. So the last thing I want to talk about is technical, and here's where I'm going to get into a fight with Andy just a little bit. The first thing we're going to look at is the short-term technicals. So look at this for just a second. Andy, you're not allowed to look at this. These are ranked in order of best to worst on today's readings, and you can look at international as the worst. Okay, so over the last 3 or 4 weeks, international stocks, the short-term technicals have rolled over a little bit. So we have, and I'll talk a little bit more about it, but we have decreased just slightly our international allocation. Overall, technicals are better than they were at the end of the first quarter. So if you look back at the end of March, everything was red and yellow and orange, right? Well, right now we have a lot of green in bonds and stocks. So we feel a little bit like there's a balance here, and overall it's a little bit a little bit supportive for us. Lastly, I want to look at a chart that Andy might find more favor with, and it is a chart of the EFI versus US stocks. And so the black line is the S&P 500, and the yellow line is the Morgan Stanley EFI, so non-US stocks. And what I've charted here is something that a lot of people look at in terms of a very long-term technical. So we've drawn a line across the last high, and that was in 2007. The last high for international stocks was in 2007. They have just begun to get almost back to their highs, whereas the S&P has doubled since 2007. So one of the things you think about is this is actually a resistance area right now. It kind of, you might tend to bounce off of this, but if we break through this, it all of a sudden becomes a support level. And so if we break through this, we're going to feel pretty good about international stocks. And to Andy's point, he made some really good points about the fact that the U.S. market is has a lot of things supporting it that may not be there for the long term. We feel over the long term, international stocks may be approaching a pretty good setup for good outperformance in the future. So more to come on that, but I thought I'd point this out because we've finally gotten back right to their high. So to wrap up our navigator as a whole, technical is neutral, valuation's negative, and the economy and sentiment are slightly positive. And this leads us to a neutral allocation. So we did make one short-term technical move though. What I want to do is talk about that move a little bit. If we go through our allocations, we're going to go ahead and drill down on the moderate allocation. And if you look at that allocation, the second line down, the US SMID growth is 12% now. And two lines below that, developed large cap is 10%. We made a shift from developed large cap. We reduced it by 4% in the moderate portfolio, and we put that 4% towards SMID growth. SMID growth was 8%. So that was the one change we made based upon the investment committee a couple of weeks ago. And it was because these short-term technicals for the international have rolled over a little bit, and the technicals for the US have remained positive. So we'll see how that plays out, but wanted to keep you up to date with what we're doing in the portfolios. With that, I will hand it back to Cole, and hopefully we have time for a couple questions.
Thank you, Nathan. In the interest of time, we may need to move on. We do have a few questions we can get back to throughout the rest of today and the week. And so I'll begin to wrap up our call with a quick word on performance. These are our model allocations, ranging from equity down to preservation with their blended benchmarks. We always highlight this. If you're an investor with an advisor or use our solutions, I encourage you to look at your specific account performance. This is representative of the model. But a few things to kind of highlight. One is that our longer term performance, as we showed throughout the year last year, continues to be very strong. For every portfolio that has a 3-year track record, we're outperforming our benchmarks in every allocation. That's also true for the inception time period. The preservation portfolio didn't come online until about a year after the others, so it does not yet have a 3-year track record. As you look more recent, the 3-month and the year-to-date time periods, in our more aggressive models, there is a little bit of slight underperformance. We attribute that to partly to we had a really good year last year. For example, our equity model outperformed its benchmark by 10% for the year 2020. So part of this is as the market has come back on in Q1, begun to kind of level off a little bit in Q2, and now today and this week flat, there's been a rising tide lift all boats type scenario. We do a lot of work on finding good managers like Andy. They in then turn do a lot of great work on finding high quality companies. And so that's what allowed us to weather 2020 really well, where in 2021, there's been just a general lift of the market. And so our high quality names, where we're biased, have already done well. Everything else is now sort of caught up, which causes some of that relative slight underperformance. That's not necessarily true in our more conservative portfolios. We have done a good job there. Year to date, our preservation, conservative, both outperforming their benchmarks. The objective of those strategies is a little bit more protection a little bit less risk. As Nathan was just mentioning, given the environment, given sort of our navigator outlook, that does in fact impact directly how we position portfolios going forward. And so one of those things that we've done is begun to take some risk off the table. That began back in April. Nathan just mentioned a few changes we made this month, and that actually has served us well in the last few days and weeks. If you're monitoring your specific account performance, we actually have fared well because of some of those positions. I would say, just as a general reminder, part of our investment philosophy is long-term, and so the volatility that Nathan mentioned, we should be expecting that. You as a client or investor should be expecting that. We're ultimately trying to look and set you up well for your long-term goals, whatever those are for you and your kind of specific financial plan. So keeping a focus there. With that, I'll kind of finish and leave us here. If you are an investor or client, I encourage you to reach out to your advisor to learn more about our investment solutions and about values-based investing. If you're an advisor, I would encourage you to email us at info@oneascent.com or go to oneascent.com, our website, or any of our social media profiles, LinkedIn, Facebook, YouTube even. We'd love to speak with you about how we can serve you and your clients with values-based, kingdom-driven portfolios. We have lots of resources we could share, our allocation dashboard, fact sheets, commentary, lots of resources to support and equip you, and plenty of ways to get in touch with us. With that, that will conclude our call for today for Q3 2021. We look forward to speaking with you again next quarter, and thank you for your participation with us today. You may now sign off the call. Goodbye.